to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Production every week, and still kind of amazes me. I'm thinking, wait a minute, that's my company. So I'm back here. We've got Mike Seeger with me. Welcome back, Mike.
Hi, thanks for having me back.
No problem. Mike is a student at Case Western, and is majoring in economics, I believe. And do you have a minor there? Or?
No, I don't have a minor picked up.
Okay, cool. So major in economics, so we got a lot in common that way. And Mike is actually going to be helping with the Look Out for the Bull website that we are resurrecting. Actually, he will be doing most of it. I will be assisting, doing a lot of the content. And it's going to be a lot of fun. So you want to stay tuned. We'll have Mike on back periodically because Look Out for the Bull website. It's going to be a different website. It's very positive, I think. We're going to basically tell you how it is, what you're up against, which is kind of the way I like to do business. It's the way I like to be treated. If I'm going to go into something, tell me what I'm up against and be real. Don't mislead. Because I'm a big boy and I can take it. What I'm really not fond of is when people aren't upfront about things, or they disclose things later on in the process after you've already signed up. So we want to try to avoid that if possible. And we got a seminar coming up here, and I had to do this one on a Saturday morning. I normally reserve those for the summer, but all the Thursday evenings were reserved. So what I'll be doing is October 27th, so just a few days right before Halloween, we're going to meet back at the Corporate College on the East Side, 8:30 in the morning, Saturday morning. It's going to be literally 1 hour. I know everybody that knows me is going, oh, yeah, right, it's only going to be an hour. But no, it's going to be an hour. So we're going to start at 8:30 sharp, and I'm going to talk for a half an hour. And the topic is going to be, we're coming into, by the way, I didn't edit this. I should have checked this before I approved it. Yeah, anyway, but it sounds really weird. But coming into what has been the best 6 weeks of the year for the past few years, and why? Because that's where we're coming. At that point in time, there will be a little bit over 6 weeks left. But actually, I think starting near the end of October, it's really more like a 6 to 8 week time period. But for the past few years, market's been doing very well. In fact, a large portion of its annual gains have been made during that time period. So I think this is a really good time to take a look at why that has played out that way and what we're trying to do in order to help ourselves best capture as much of that as we can. And now that I've actually said that and put that out there, it'll probably, the market will probably take a dump. But I don't know. I think there's some reasons for it, and I think those reasons are probably still in place. So we'll talk about that. That's going to be the topic of that particular seminar. It's going to be quick. It's going to be very quick. We're going to talk a little bit about the Look Out for the Bull website that is under construction and going to be released here relatively quickly. And again, Mike's going to be a big part of that. He's actually going to be the biggest part of that. I'm just going to provide research and some commentary, and he'll be doing the heavy lifting. So I don't know what you think about that, Mike. Yeah, hopefully.
I'm excited for that. That's what I'd have to say. I'm looking forward to it, and Bill is pretty great to work with.
Oh, that's awesome! And
he didn't pay me to say that.
And that's I was gonna add that. So anyway, if you have a phone call, question, or comment, 216-901-0945, 216-901-0945. And Mike and I were meeting this morning. We're talking about different things. We talk about a lot of different stuff. I don't know that we talked about this in particular, but I think that the financial planning aspect of most people's lives, it's actually relatively simple. There are a lot of things that you just can't know answers to. And I think that's a big part of the whole financial planning process is figuring out what you can know. Try to figure out what you can know. A lot of things you just can't know the answers to. People come for help on a lot of that, and oftentimes it comes down to, well, you just have to do your best effort, give your best effort to come up with an estimate. That's what you've got to do. And you're telling me, I think it's really fascinating that you're taking econ courses. I haven't opened an economics book probably, I don't know, since a few years after I left college. So I'm sure they've changed a lot of the things that they're doing. But
well, I think a lot of it that I'm going over right now is the pretty basics: demand, supply. How a market reacts to price changes, stuff like that. So I don't think they've changed much about the whole body of economics in the past, 20, 30 years. But
I'd be really interested to see what they're going to be doing as far as the data goes. Back when I was in school, a compact disc was the size of a vinyl record album. Mm-hmm. have you ever seen an album?
Oh, yeah,
okay.
Yeah.
So that was a compact disc back then. And Kent, which is where I was going, actually had a deal with the Federal Reserve. They published data and provided it to Kent, so the people from Case and all the other local universities that wanted at Ohio State, their graduate students were always coming up to our library to access that.
Huh.
And because they didn't have the internet back then. So if you wanted to use that data, you had to come to us. And I don't know how they got selected for that. I thought it was awesome, but and I would use it occasionally. But today, that's the part that's really fascinating, because there's a big difference between correlation and causation. And I think you'll probably find that a lot of econ guys confuse the two. It's easy to do. Mm-hmm. That's really easy to do. Correlation means when this happens, this has happened X percentage of the time. Okay. Causation is if I push down on the left-hand side of a seesaw, the right-hand side is going up. Now, that could be very misleading, especially if you put a wall dividing the left-hand side and right-hand side, just giving enough a hole in the wall so that the joint can get through the wall, and you can make that happen. But if somebody got wise and cut off the left-hand side and put a small lever on there and then started moving it randomly, you might not be able to tell. And let's say you could only see the two seats. So you'd see the left-hand seat sitting there on the ground, and you'd see the right-hand seat going up and down because some smart aleck decided to try to trick everybody.
There's the example I've always heard to explain correlation is that if in the summertime ice cream sales go up,
right,
and so do sunburns. Yeah. So does ice cream cause sunburn? It's right, that general idea.
Right.
Yeah.
Yeah. I love it. Do they still use the guns and butter thing?
Yes.
Oh,
yes, man. They do.
That one killed me.
World War II. Yep.
Yeah. Wow. Okay. I wasn't a really big fan of that one. There are a lot of things in econ that I didn't like a lot, but I'm really interested because now they've got so much more data. The data is better. The ability to handle and process data is a lot better. But as you mentioned a little bit earlier, the basics are not going to change. The ability to track the basics has changed a lot. We've improved on that quite a bit. And so I think that's, it's pretty exciting. There are a lot of hedge funds out there that run macro and microeconomic analysis and are actually using it to manage money. They've been doing that for a long time. Most of the time, it hasn't worked very well.
I wouldn't think so.
Yeah. But they are making strides in that area. So I think that's pretty cool. And that's where when you think about the basic logic behind investing, the basic logic really hasn't changed a lot. How you execute that logic has changed. So the basic logic is if a stock's sales and profits are rising, if the company's prospering, eventually its share price goes up. Well, that hasn't changed. The speed at which they go up has changed a little.
Astronomically.
Both directions.
Yes.
And actually the choppiness how much a stock will fluctuate within a range has really has changed. A lot. So that portion has really changed. But there are still some basic things that you can do to help yourself deal with that. If you're an investor, you've got to deal with it. So how do you do that? That's what the Lookout for the Bull. That's why you're here. And we're going to have a methodology, or I said I wasn't going to use that word, but then I said
checklist.
Yes, we're going to have a checklist. You're going to use a checklist to help you, and it's all based on fundamental logic stuff that's really simple. And anybody can do this, but I'm going to caution you. We're not going to promise to make people rich overnight. Don't want to do that. Investing can be hard. At some point in time, it will be. At other times, it seems easy. And you need to enjoy those times. Remember those times, because when you're going through the hard times, you can think back to those. Sooner or later that those conditions reappear. You don't know when, and I think that's a big part of the problem. And kind of like, the Browns were so bad for so long, and all of a sudden this quarterback comes in, starts looking pretty good. And by the way, the quarterback looks good because the receivers and offensive line are playing really well. So they're all looking good. Is that going to stay that way? You don't know. You hope. Looks like they might have things on track. And investing is very similar. It always amazed me how similar the stock market was to real life. You have a lot of things that are okay. It's okay. You get by. And then occasionally you'll have, wow, that was really good. And then occasionally you're really scared. And so I think that's one of the reasons that people will always need people like us as really coaches, to say, yeah, this is normal. This is absolutely normal. Because if you're not like you are, you're starting to study much earlier. Hey, that was interesting. That was a blast from the past. Sorry, got held up on my way into the station this morning. And it's amazing how time goes so fast when you're doing things and then you get stuck somewhere. Anyway, so I did want to thank you. What we were playing last week was a show we were talking a little bit about. Lookout for the Bull. It's a website that's under construction. That's going to be coming back. I know we've had that a couple times in the past. We give that another shot. Hopefully this time the technology is good enough that we won't have to take it down again. It's amazing how technology has improved and changed over the years. It's really changed a lot. I'm really a big fan of technology. I'm a big fan of the changes. Not all of them. Not all changes are always that good, but I would say for the vast majority of the the major changes I've seen in technology, I'm really excited about it. In fact, we'll be talking a little bit about that at a seminar that's coming up here. I actually have to look it up. Oh, some guy, when I typed in Bullington, he came up ahead of me on Google. Don't know why that happened. And the connection is a little bit slow here, but I think there we go. This is Saturday, October 27th. It's a Saturday morning. It's going to start at 8:30. And I decided to talk about what has been the best 6 weeks of the year for the past few years. And why? Because we're going to be very close to the last 6 weeks of the year. At that point in time, will actually be a few weeks before the last 6 weeks. But it's been very interesting, the end of the year, each year for the past few years. Not each year, but 5 out of 6. The market's done very well during that time period. So I thought that would be interesting to kind of take a look at why that is, what you might be able to do in your portfolios if you are thinking about doing something. And by the way, most people should probably not be thinking about doing things most of the time in their portfolios. They should have the thinking done before they're invested. That's kind of a big key to being successful, I think, in the stock market, is that you already have a plan. You know what you're going to do. If the market goes down, that's, people ask a lot of time, what do you do if the market goes down? Well, I'm probably going to hang tight. If it goes down a lot, I'm probably going to rebalance my portfolio. And a lot is a vague term. A lot for me is anything more than 15%. I get anything more than 15%, I'm probably going to look at rebalancing the portfolio, but I'm going to wait. I'm going to wait for certain things to show up, and then I'll rebalance it. So if we got a 15% correction, which we have not had for quite a while, and I think some people get nervous over it. Some people don't get nervous over it. I'm not really sure what you think. All I think is that stocks valuations are still pretty good. If you take out the large cap growth stocks, the valuations are very good. So I think there's room to go. And if we did get a correction, I would really be interested in adding to the holdings that I have. That's what I'd really be interested in doing that. And particularly the things that are more bent a little bit towards technology, because I look at the growth rates of all the industries. Technology's got the fastest growth rates, and not all technologies, but a large number of them. And their valuations are not nearly as high as they have been when those markets have peaked out in the past. So I think there's still some gas in the tank there, and that should be fun. By the way, the guy that you were listening to that was there with me, his name is Mike Seeger. He's actually a student at Case. He's going to be running the Lookout for the Bull website. I'm actually going to be providing content and research. So this is a joint venture between the two of us. He's got the time to do those things. We'll have to talk more about that after the commercial messages. You're listening to Bill Bullington right here on 1420. Stay tuned.
And I simply come longing just to bring something. Well, I wish I had a short-term memory. Wish the only thing my eyes could see was the future burning bright right in front of me. But I can't stop looking.
And we're back. Hey, if you'd like to call in today, if you've got a question regarding investment planning, the retirement planning, feel free. 216-901-0945, 216-901-0945. If you'd like me to take a look at a stock, give you an opinion, that's fine too. I have to let you know, when you give an opinion on a stock and it's something that you haven't looked at in great detail, there's a way of doing that is fairly it's fairly decent, but it's not going to replace the really intense work that you need to do if you're going to invest a significant amount of money in a stock. So I just need to put that out there, because oftentimes people call in and they want to talk about a stock, and I'll look it up and I'll give them the 60-second test. Basically, I'm looking at the sales and the margins. Most companies, I know the industries fairly well because I've been doing this for so long, and I can tell you what the averages are and how that looks according to the averages. Very similar to if you were looking for a house. If you're looking for a house, you're going to look for the houses that are closest to that house and see the ones that are most similar to that house, what they've sold for. And that would give you an idea of whether or not the price that the house that you were looking at was in the range of the other houses. That's essentially what we're doing with stocks. That's what a stock picker does. Goes in and looks at the company, looks at the sales, the profit margins, tries to figure out what they do for a living, the business living. Sometimes that's not easy to do. That's one of the red flags. When I see something, or I go to look at a company and I don't understand the industries that they're in, and they're in lots of different industries that really don't have a lot to do with one another, I would recommend that the average person just stay away from stuff like that. Warren Buffett's got this file holder on his desk, and it says "too hard." That's what he means. Is those businesses are too hard. Why are they public? Well, at some point in time, it was probably different, maybe, but there's a pretty good bet that at some point in time they decided that, hey, you know what? We could probably use a big shot of capital. So if we go public, we'll raise a bunch of money and we can keep buying more businesses. Yeah, those are really tough to kind of get your arms around. You can try, but it's very difficult. So as an individual investor, I would kind of take a look at just whatever it is the company does. If you don't understand it, or you see a whole bunch of businesses that are not related to one another, that happens fairly often. Peter Lynch used to call that diversification. These guys are diversifying their businesses, and it's making it harder on the business, not easier. Yeah, but those are long stories and kind of boring too when you think about it. But if you've got questions, comments, feel free to give us a call. You can also email me, bill@bullingtoncapital.com, or you go to my website, which is bullingtoncapital.com, and you can sign up for the seminar. We're going to be looking at what's been the best 6 weeks of the year for the past few years and why. The seminar is going to be Saturday morning, October 27th, 8:30, Tri-Cities Corporate College, very nice place. We'll get in, we'll get out. By the way, the seminar is going to last just an hour. Actually, I've made a deal with Gary that does all the trading and IT and a lot of other stuff for Bullington Capital. He's going to drag me out. I'll actually have to run because I'm going to have to come here and do the radio show. So it's just an hour. There's a continental breakfast. You can come in and take a look around, get to know us, see how we do things. I think that's an important thing, that you're very comfortable with your financial advisors. That's a big deal. You should be very comfortable with your financial advisors. If you're not, then, well, actually, sometimes people aren't comfortable because a lot of financial advisors will tell them things that they don't want to hear. That happens sometimes. And, you have to respect those financial advisors that are telling you something that you probably don't want to hear, because they're doing it for your own good, most likely. So I guess, in that instance, you wouldn't really be in love with your financial advisor. And I know a lot of people that do have kind of a love-hate relationship with their financial advisor, because they come to them and they want their financial advisor to agree with what they're saying, and the financial advisor can't do that because it's they're wishing for something that's actually not there sometimes, or they're trying to get something or an answer to where there are no answers. And what do I mean by that? Well, when somebody comes and asks you, when should I take my Social Security? Okay, well, you're going to have to gather up all your data, and you're going to have to make an estimate, because there's no way of knowing when the perfect time to take Social Security is. Why do I say that? Because you don't know how long you're going to live. If you knew you were only going to live a year or two, take it as early as you can. If you don't know how long you're going to live, well, then you're just going to come up with an estimate. Just have to do the best you can. And since you also don't know what the cost of living increases in Social Security are going to be, that affects that as well. The current rules can change. That will affect that at some point in time. So there are a lot of questions that people oftentimes ask that nobody really has a good answer to, and you have to come up with the best estimate that you can come up with. I see this all the time with pensions. A lot of pensions are incredibly confusing. By the way, your pension has to provide an annual statement. You get an annual statement from that. If you haven't seen one, you should probably contact your HR department and ask them for that. Ask them if you can get an annual statement of benefits, because it's a really important thing when you're sitting down and you're trying to figure out how much money you're going to need for retirement. That income that's going to be presented by or provided by the pension is substantial, even if it's only a few $100s a month. I'll give you an example. Let's say you got $400 a month. That's $4,800 a year. If you're going to pull out 5% from an investment portfolio to supplement your income, well, that $400 a month is worth almost $100,000. So why? Because 5% of 100,000 is right around 5,000. $400 a month, a little less than 5,000. So right around $100,000 is what you would need to replace that $400 a month. Think about that for a second. $400 a month, you would need $100,000. Now that to some people, they go, "Oh, hey, great! I never thought about it like that." Other people go, "What? That's a lot of money." Yep, it is. It's a lot of money. The vast majority of people in the United States are going to retire, and they're not going to be able to maintain their lifestyles, and that's a reality. They're going to retire and not be able to maintain their lifestyles. Now, many of them won't mind because their lifestyle was so good while they were saving, or getting ready to retire, that they're ready to cut back. They're ready to stop doing a lot of stuff that they did before. That's fine. Everybody's different. There's no right or wrong. There's I like to say, but there is a right or wrong for you. Anyway, got a couple callers calling in here, and if you'd like to call, the number is 216-901-0945, 216-901-0945. And I think I just lost one of them. And I'm going to go to the second one, and I've got Chris. Chris, you're on the Bullington Capital Report.
Hi.
How are you?
I was just curious.
Mm-hmm.
Oh, good. Sun just came out.
Well, that's good.
Yeah. Hey, one of the, I don't know, I know it's reported, but it seems to be a most under the radar thing going on. Chinese stocks seem to be in a depression. I mean, even the good names are down 20%. The other name, and a lot of them are down 40% from their high.
Right.
I mean, is this a buying opportunity, or is it to stay away from Chinese stocks?
Well, I don't invest in them. I just don't. There are lots of reasons for that, and I could probably spend the rest of the show talking about it. But to verify, the number one is to verify what the Chinese companies are actually doing is impossible. They don't care. They can say whatever they want. They've got some standards. I don't want to make it to sound like it's the Wild Wild West out there, but portions of it are. Portions of it are the Wild Wild West, and you have no way of verifying any of that data. It's very difficult for the SEC and the New York Stock Exchange to verify the data on the stocks that actually trade here. But I just don't invest in things that I can't get good quality information on. That doesn't make sense. That's not really an investment. It's more of a gamble. Investing and gambling are oftentimes a lot of what I do. People think it's gambling. No, we're using math. We're calculating probabilities. That's a whole lot different. That's what investing is. That's what life is in general. But yeah, so I would not want to invest in Chinese stocks directly just because I can't get information that I can rely on.
Okay. Well, I was just curious. It seems like I said, even the supposed good names, are just way down, and it seems like they're just blaming it on Trump and the tariffs as opposed to anything else.
Yeah, again,
and Trump will go away eventually,
yep.
whether it's 2 years or 6 years. He's eventually going away.
Yeah, and hopefully one day, their markets will be more transparent. That'll make it a lot better. But for now, I would just,
or even the ones that are on the New York Stock Exchange, like Alibaba.
Yeah,
Alibaba's like 160 or something, or maybe 152.
Do you know what Alibaba's? Well, here's the thing, and you call it a lot, but you'll bring something up like that, and do you know what Alibaba's revenues are?
I think they're, I don't know, 60, 70 billion, something like that.
It's 43 billion.
Right? Okay.
So the market cap of the stock, do you know what that is?
It's 400 billion. So
yeah.
I do know that.
Yep. So if you divide
down from 600 billion.
Yeah. So if you divide the market value, and bottom line is, it's got a price to sales ratio that's over 9, which I don't know. If the growth rate ever slows down, there's so many things that could happen there. That's not one of those stocks I'd look at it and go, well, that's super cheap, because 9 times your annual revenues is huge. That's a big market cap. That's a high price to sales ratio. So you're paying a super premium for that stock. Now, maybe it's worth the super premium. I'm just not a kind of investor. I don't like.
Well, isn't that true, though, for things like Amazon, which everybody loves?
I don't love Amazon. I've never even talked. I rarely bring up.
What are the revenues there?
Yeah, its price to sales ratio is
that's 9 times.
No, it's 4.5. It's actually 4.5. So it's half the valuation. So these kinds of questions, though, realistically, this is what I like to do. I like to put a set of rules together that are going to determine how I'm going to invest, and then I like to stick to the rules, because what we're participating in is trying to get a feeling or an intuitive feeling, because all the numbers are out there for everybody to see. Everybody has them. So if you're going to beat people who use the numbers, you're going to do it because your intuition is better than theirs. And you know what? That is a really tough way to manage money. That's incredibly difficult. So I'd rather not, do it that way. And Amazon's been in multiple models I've had over the years. In fact, I'm sure it's in some of the ETFs I hold now. So, but
well, let me ask you this question. Since this Chinese market has crashed so much, what are the odds that this is now going to affect the U.S. market, because we've got so many goods that come from China, and start crashing our market 20%?
The market will crash at some point in time, and nobody knows what is going to trigger it. That's just the way the markets work. And trying to predict that or trying to figure it out, man, you're wasting time. I feel like it. If your plan doesn't already include what you're going to do, then you don't have a plan. You need to get one. Yeah. You really need to get one, because these questions are from people that are guessing. And you can't afford to guess when it comes to, or you can if it's your play money. If it's money that you don't mind losing, then you can guess and you can, speculate all you want. But I think you really need to develop a good, solid plan and then stick to it. It really takes a lot of stress off of you.
Yeah. Well, okay. Well, I'll leave you with one other thing. Years ago, remember Oldie, those guys?
Oh, yeah.
I had a guy there that told me, he said, always watch what the Fed's doing and don't fight the Fed. When the Fed's lowering rates, you get in stocks. When the Fed's raising rates, you get out.
Yeah.
I don't know if that holds true, but these interest rates, especially this 10-year Treasury bonds, really jump. God, what's a jump? 20%? I mean, 10%?
They're actually about 40 or 50% from where they were at their lows.
Yeah.
So, yep. But hey, Chris, I got to run. I got to take another phone call. But hey, have a good weekend. Mark, you're on the Bullington Capital Report.
Hello, Bill. This is Mark. I was wondering, could you explain the blackout rule, and do you think it's affecting the market because companies aren't buying their shares?
That's an interesting question. The blackout rule is when a company goes public, okay, that they've got to wait before they can actually sell their shares. So everybody gets shares. By the way, going public, do you realize that is a total reorganization of the company? They're reorganizing. Hey, Mark, can you hang on for a second? I got to take a real quick commercial break. You're listening to Bill Bullington right here on 1420 The Answer. I'll be back after these messages.
When peace lies.
And we're back. Hey, Mark, you still there?
Yeah, I meant the buyback blackout.
The buyback blackout. Oh, that's just a period of where anytime somebody makes a substantial change to the business structure, oftentimes a blackout period will accompany that, where the insiders are not allowed to buy or sell, until the news is fully disseminated, and that it can last from anywhere from 3 days to 60 days. But that would be a typical blackout period if somebody made,
like when they're buying another company or something, a merger talk and that kind of stuff.
Yeah. Yep.
Or a spin-off or whatever.
Right. Yep. And when they go public, and that's actually what I wanted to clarify. If they go public, there's typically an initial public offering lockup period where they can't buy or sell stock, for a certain number of days after the company's come public. So very similar. So I didn't know which one that you were actually referring to.
Yeah, I should have clarified that. That's my fault.
Well, that's okay. So you were asking about when they make an announcement.
Well, so like, what is it? Like 30 days before they announce the quarterly results, they can't be buying their own stock and stuff.
No, that actually would be, well, the company's going to set those guidelines internally. And they have different time periods. So it could be as little as 3 days, could be as much as, a couple months. So,
oh, okay.
Yeah. But the company generally gets to set that. And to the best of my knowledge, I don't think there's a standard that everybody uses or is forced to stick to. I think they have a range of number of days that they can use.
And they do this so that the insiders don't have this exceptional advantage over the the general public.
Right. Yep. Insiders, when they're buying, insiders are generally really, really early. Now, I should preface that by saying I have not looked at insider buying or selling in an incredibly long time period, because the institutionalization of the investment financial markets in the United States has made funds way more influential than any of the insiders. And insiders are generally really early. I mean, if they're going to buy stock based on something that's in development, they're buying when they're in the developmental stage before that has ever even been announced.
On a scale, too, then, right? I mean,
pardon me?
An individual would only have so much money, unless he's, Warren Buffett. But
and by the way, a lot
might have billions of dollars, right? They're the elephant in the room, right?
Right. And by the way, I've seen a lot of insiders lose an awful lot of money investing in their own companies.
Since sliced bread, and then it wasn't.
Yeah, I've watched them actually literally go bankrupt. CEOs.
Wow.
So that it's everybody's looking for that edge, and you basically it's kind of like you're keeping a checklist of things to look for if insider buying is important to you. I just haven't seen anybody that's really used that for a long time, because the amount of patience that you would have to have, knowing that these guys are probably looking at a project that's under development that's coming out 2 years from now, and they're investing now.
Yeah, I've worked on a project that took 2 years.
Yeah.
They went from $7 million to $14 million. There was a couple hundred engineering changes.
Wow.
And they still argued over the last $2 million.
Well, I'm sure, that kind of stuff happens a lot too. So, yeah, it's interesting. That's one of the reasons that I'm really a big fan of using checklists to develop, what kind of stocks you're going to buy, how you're going to buy them, how you're going to sell them.
I'm very much interested in that. Okay, let's say I don't want anything with a price of sales of 9 because, that's just too rich, right? I think one time you said Microsoft back in 1999 or something like that was selling for like 24 times revenue, right?
Yep, absolutely.
So maybe if you had a checklist, nothing over X number of price to sales ratio, nothing over that, and that kind of thing, would that be is that the kind of thing you're talking about? Yeah,
I'll give you one since you brought it up. So if you take the enterprise value instead of the market cap, market cap looks at just the value of the stock.
Right.
Enterprise value adds all the debt and then subtracts out the cash they have. So essentially, it's what you would be paying for the entire company, because if you bought the company, you're going to have to assume the debt too.
Right, but you get to keep the cash.
Right. So if you look at enterprise value and then you divide their earnings before interest and taxes, it's a measure of cash flow. So if you were to divide that by the enterprise value, it gives you a yield. And then I like to do that on the 1,500 largest companies in the United States. The overlap with the S&P 1500 is eerie. And then we take the top 50 stocks out of that. And every 6 months, we're going to rerun that screen, because stocks move a lot. I mean, they move a lot. In 6 months' time period, they can move tremendously, especially with something like this, because what you're doing is you're taking that measure of cash flow that you got, you're dividing it by the cost of buying the entire business. So it converts it to a yield. Now you can compare companies to each other on a much more equal basis. And the bottom line is, if you're a business owner and you're investing, you want to own those companies that are generating the most cash per dollar that you're paying for the business, right?
Yes.
Yep. So you just want the ones with the highest yields. Pretty easy to understand.
Yeah, I mean, you wouldn't buy a CD. You wouldn't buy a CD if it's 1% when you can get it for 3%.
Right. And that's exactly what this does.
And so that's how they convert it.
That's how I did it for this particular checklist I came up with. And I call it the BCAP value model. There are 50 stocks in it every 6 months. That's enough. We're going to add that, by the way, to the Lookout for the Bull website at some point in time.
Well, that'd be good.
Yeah, we're going to start with, and we'll publish that list every month, because every month, depending on when you start, your start date, you're going to be different. Stocks move. Some stocks will still be there because they haven't moved, or maybe they've actually gone down.
Yeah, look how fast AMD moved this year.
Oh man, that was huge. Yeah, that's what I'm talking about. So, and what you're doing with this, it's a very deep value model. You're looking at stuff that, in many cases I look at it and go, oh, it's painful for me to buy those companies because I'm looking at the company. But their yields are like 15%. So you have to kind of ignore your emotions and just go with the math instead, go with the numbers. And that has a tendency to work a whole lot better than me trying to figure out intuitively.
Well, that's what's great about math, because 2 + 2 is always 4. It's not today I feel like 3, tomorrow I feel like 5, right? Right,
exactly. And it's one of the nice things about being able to access all this software today. The programs that I tested all this stuff on were incredibly expensive. The one that I run the screens on, with the result that I finally arrived at using the really expensive software, it's only $350 a month, which for me was a big break over what I was paying for the other software. And part of the technology is advancing and bringing costs down. It's pretty cool. But yeah, that's the BCAP value model that we run through my firm.
BCAP, okay.
Yeah, I like it. So we're going to publish that. So if you were going to do this on your own, there's only one, well, maybe two. You could probably do it at Interactive Brokers. Interactive Brokers doesn't allow you to buy fractional shares. There's only one brokerage firm I know of that would allow you to execute this strategy, because you're going to be buying fractional shares when you do this, and Folio lets you do that. So you can have a retail account at Folio. You'll be able to go in, download these securities, and upload them right to Folio and hit synchronize. It'll make your portfolio look just like the list.
Wow.
Yeah, that's pretty cool.
It is.
Yeah.
Hey, that assistant of yours is the student there. Was he working on his dissertation, or?
Oh, he's just a young guy.
Is he?
I think he's only a junior.
Does that have something to do with his major?
Yeah, he's majoring in econ. I tried to talk him out of it, but.
Well, yeah, you get two economists together and you got three opinions.
Yes. Maybe
how
not,
the joke goes.
Maybe like me, it'll be 9 or 10.
So it's a Berkshire A. Is that a Giffen good? Robert Giffen, Sir
Yeah.
Robert Giffen. Yeah,
I remember. Yeah, I don't know. The Berkshire actually defies most conventional businesses. I think it's interesting. The vast majority of their profits have a tendency to come from the financial side. So, but they own a ton of stuff. It's hilarious. I think it's over 80 companies now. Yeah, and they own a boot manufacturer. They actually have the largest solar farms in the world because they own the largest investor in solar farms, which is, I think it's Mid-American. It's a utility company.
Okay.
And so he's got, all the bases covered throughout all the companies that he owns. I think it's a riot. And this is a guy that really didn't like technology. He used to talk about that a lot, how much he didn't like it. So now he owns a lot of it. But anyway, hey, Mark, I got to run because I hear the music.
Let you go.
Thanks. Have a good weekend. Thanks for calling, too.
Thanks.
And you're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. Also carried on the Fish's website, 955thefish.com, as a podcast. Have a good week, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420 The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.